Hello, I'm Russell Poynton from Edison Group, and once again, it's great to have the management of Global Fashion Group with us. We have Christoph Barchewitz, who's the CEO, and for the first time, we have Helen Hickman, who's the CFO of Global Fashion Group. So welcome both.
Welcome, thank you.
Thank you. So let's start with the results were published yesterday, as I said, and the FY25 looks like a very good year of progress from an operations perspective and a financial perspective. So could you just talk about, give a bit of a summary of the journey you've been on in the last 3 years to get to where you are today?
Definitely. So from between 23 and 25, we've been operating with some demand pressures. And our NMV, so our top lines, declined over that time for about 168 million. And about half of that actually has been FX. So we've seen devaluation of currencies against the euro. Against, though, that declining backdrop of sales, we've really stepped forward both our profitability position and also our cash position. So we've moved forward on profitability by 62 million euro. And I'm excited to say, as you mentioned, that in 2025, we were adjusted EBITDA profitable at both the group level, and also each of our 3 regions were also profitable at that level. That's then translated into a significant reduction in our cash outflow by 30 million. So we reported yesterday a 32 million operational cash outflow. And we've been able to make that pivot around profit and cash across both gross margin and our operational cost base. So we saw a 4 percentage point improvement in gross margin, and we've been very disciplined around cost and efficiency and taken out just over 100 million of cost over that time frame.
Great, thanks, Helen. So Christoph, let's move on to the 3 regions, different dynamics in all of them. First one, the biggest, Australia, New Zealand. To some extent, it's probably quite easy to take it for granted in that it keeps on growing and it's the most profitable. So could you just talk about what's happened in the last 12 months and to drive that profitability and the good performance from the KPI perspective?
Yes, we're very excited about Australia. As you said, it's the profit engine and the growth engine of the group. 6% growth last year, very strong EBITDA performance, stepping forward on gross margin as well to a record 49% margin. So we're very, very pleased with the financial performance, but I think equally important, if not more important, is really the initiatives behind that. So the platform transition towards a higher share of marketplace, now touching on nearly 40%, is very pleasing because it ultimately brings more assortment without putting money into inventory to the customer. We've made a lot of progress on delivery, so we've upgraded that in our partnership mainly with Australia Post. We launched just recently Saturday delivery, which is not a common thing in Australia, especially in the fashion e-commerce world. And we've also upgraded the experience for our customers in New Zealand. And so all of that is clearly helping. We have also done a lot of further work around the customer. We launched a new loyalty program in October last year, so it's still early days, but the intention behind this is really to drive order frequency where we think we still have room for growth going forward. And we're also very excited by our continuing Got You Looking master brand campaign initiatives, which has been a big driver of the return to growth over the last few years. And we think there's more in that we can bring to the customer to really articulate the proposition very broadly across categories, the delivery promise, the brands that we have. And so very excited about the journey ahead for Australia and New Zealand.
Okay. And moving on to LATAM, the active customer numbers there tend to be a little volatile, and you're still showing that. So, but still growing. The business is still growing and moving, is in profit. Could you talk about what you're doing to counter that competitive environment that you've talked about?
Yeah, it's a very competitive market, as you say. I think what's very important is we talk a lot about the active customer, and that's somewhat of a lagging indicator. And is only part of the story. The other part of the story is really the order frequency. And our order frequency for the group is at about 2.3 orders per year. It is a bit lower than that in LATAM, but it's actually grown 5% last year. So there's a bit of a trade-off, and we are really focusing on the higher value customers and engaging them on a more frequent basis to drive growth through not only the active customer number, but the number of orders and the order frequency and the loyalty that comes with that. One way of doing that is through the assortment. That is front and center in our business. We're continuing to sharpen that, drive more exclusivity, articulate it better to the customer, and then also really cater through what we call Club Dafici is a branding, a trigger to buy more quickly and really have exclusive offers that come at a great price, but also exclusive in terms of the product that is being offered. And these initiatives have really helped us drive the growth last year and will be a part of the journey this year as well.
Okay. And finally, from a regional perspective, Southeast Asia, where the customer trends are still negative, but there's a new CEO who's been in for a few months now. The business, gross profit went up, so that's good. Could you just give some insight into what's actually happening in the Southeast Asia business?
Yeah, as you say, I mean, we've definitely faced a good amount of challenges, and that's reflected in the top line. The decline has a bit moderated in Q4, so we see a bit of progress there, and Q4 is obviously a critical part of the year from a seasonal perspective. What's behind that? Our whole range of initiatives. We're focusing more heavily on our 30 largest brand partners in the region and really making sure that across that core of our business, we have the most relevant assortment, we have great pricing, we bring newness in a very frequent way. And that kind of side of the merchandising and the assortment has been a big focus of our new CEO and the whole team. We are also reinvigorating the brand position that we have. We have launched a Southeast Asian version of the Got You Looking campaign just very recently. We're currently going through another key trading season. We just had Lunar New Year. We have the Raya or Ramadan season currently. So there's all these touch points where we can retell the story of what we are about, which is fundamentally, the best global and local brands for the consumer in Southeast Asia. And so there's more work to do, but I think we're very pleased that the actions we are taking are showing some results, and we're doing that while actually maintaining a positive EBITDA position.
Yeah, great. Thanks for the update on the regions, Christoph. Helen, could we touch on the financials and the outlook for this year? So essentially at the midpoint, you've done what you did last year and guided to no growth on a constant currency basis with a range around that, but you're still expecting another year of profit growth. So perhaps it'd be worthwhile just talking about what those levers are to getting the EBITDA margin moving up again this year.
Yes, definitely. So just to recap, so our NMV guidance for the year is between -4% and +4% on a constant currency basis. And profit is between 15 and 25 million, and stepping forward from the 9 million that we generated in 25. So very much our focus around improving that profitability falls within the similar buckets that actually that we've seen over the last 2-3 years. So improvement in our gross margin, and that then really stems across real strong execution of our retail assortment. So we've landed the year with a strong inventory position, relatively low aged inventory. So we're in a good place to be able to trade that well. And then also a focus around our marketplace and our platform services business. And as they grow within and as a proportion of our business, they're also accretive to our gross margin. We're also continuing the cost and efficiency program, which very much now is sort of embedded in DNA within the organization. So we've got a series of focus areas with regards efficiency and discipline around costs that will also help step forward the profitability.
Okay. And with respect to that medium-term guidance that you've had in place for quite a while, I mean, we had a good year of progress this year. So could you just talk about the building blocks into that medium-term guidance and whether you're still confident in that medium-term guidance?
Yeah, definitely. So yes, we're definitely still confident in that. From a business model perspective, it's very much around working towards sort of a gross margin of 47% plus. So we're very much well on the way with that, with the step change that we saw this year, improving our marketplace participation. So I sort of with a target of about 45%, so we're just under 40 at the moment. And then also moving forward with platform services. as a proportion of our overall revenue. So from a business model perspective, that's where that lies. We've got the customer flywheel, so how actually we really focus around loyal and profitable customers to be able to generate incremental profitability. And then lastly, our cost focus that I've touched on. And how we're thinking internally a little bit about our cash targets is less around sort of percentage adjusted EBITDA margin, but more about quantum. So we know that in 2025, our operating cash outflow was 30 million, just over 30 million. And our below adjusted EBITDA, the components of that are relatively fixed now. So we've done a lot of work to optimize our lease profile, our CapEx. So ongoing, they'll run at about 30 million in aggregate, as they did in 2025. We've got ongoing tax and interest commitments of about 13 million. So really, if we closed last year at a sort of minus 30, we need to be able to generate broadly 30 million more profit, assuming relatively stable working capital, which very much is the sort of long to mid-term guidance to be able to deliver just normalized free cash flow break even.
Okay, that's great. Thank you. So Christoph, so there's been a good year of progress. So if we had this interview last year, can we just sort of could you just talk about where we are versus what your expectations might have been 12 months ago for the three regions?
Yeah, I think we made progress across all markets, but I would say we have pretty much delivered and maybe in some aspects outperforms our ambition in ANZ as the largest market. And really the balance of growth and profitability and the consistency of that through the year has been the most pleasing part of that, I would say, plus the confidence that we have many initiatives and opportunities to go further in a market that frankly is not as big as the other two regions, but where there's still a lot of room for growth and improvement of our proposition. I would say in LATAM, it's been a little bit less consistent, and you see that a little bit on the trends quarter on quarter. We've largely gotten to where we wanted to get to, but we certainly have to do more work around the proposition and in particular the customer flywheel that Helen mentioned in that market, and that's something we're really focused on for this year. And then Southeast Asia, we clearly had a bit of different expectations of how it's going to play out 12 months ago. We understood that, in the first couple of months of the year, we took significant actions, including on the cost side through the year. So I think we fundamentally landed at a place where the top line was a bit weaker than we expected, but we got to a quite similar place on the bottom line because of the actions through the year. And I have more confidence today that we have a clear plan of what we're going to do this year than I would have had 12 months ago. So there's been good progress in the smallest region as well.
Okay. Well, thank you. So Christoph and Helen, thank you for coming in today, and we look forward to speaking again soon.
Thank you.
Thanks for having us.